I'm Adam Myers, and I'm pleased to be joined today by Fred Pollock and Corey Lopretti from GCM Grosvenor. Fred is the Chief Investment Officer, and Corey is the Head of Portfolio Construction, and they have both been deeply involved in the management of PE1 since inception. They also bring valuable insights from the front line of private equity. So in today's session, they will discuss what's happening in the broader economy and how those trends are impacting private equity markets, and specifically how they're impacting PE1. I'll also touch on the current discount to NAV and share some details on our capital management initiatives, which are aimed to address this challenge. We will also leave time for Q&A at the end, so if you have any questions, please submit them via the Q&A box on your screen. So thank you for joining us, and let's get started.
Thank you very much, Adam. We're going to use a slide presentation, which I think, Corey, you're going to help guide, if we wouldn't mind starting on slide 5 of the slides. My name is Fred Pollock. As Adam mentioned, I serve as the Chief Investment Officer of GCM Grosvenor, and I also manage the Pengana Trust. So on this slide, I want to talk about kind of the macro environment for private equity, people's expectations going into 2025, and then sort of what's happened. What was the resultant conditions after that? So a few key assumptions are on the left part of this slide, and then on the right are kind of where we are today. And I think these are all kind of critically important to sort of understand. So everyone went into the year, you had the elections settled. There was a little bit of almost euphoria talking about animal spirits. There was an expectation that with a change in different regulatory and policy regimes, there'd be more mergers and acquisition activity. There'd just be a lot of kind of activity that people thought might bring realizations back to the private equity market. On the left here, you'll see the details of some of these. So and I'm going to go one by one and sort of explain where I think we are today. And a lot has changed during this period of time. And it'll be important for what we talk about in terms of the portfolio and obviously our expectations for the private equity assets in the Pengana Trust. So the first one, fiscal stimulus and spending in the U.S. supporting growth. So that has completely changed. So the dialogue now and the market response function to deficits in the United States has just changed. If you think of COVID and a little bit of the post-COVID period, generally speaking, deficits were received by the market with yawn. You didn't see a big response in interest rates. You saw some growth from that deficit spending, but you didn't see a negative kind of market response. That's completely changed. So now you have a backup in interest rates. Kind of the 10-year, the 30-year in the U.S. is backed up. That's actually coupled with just a general kind of consensus that the U.S. is on a slightly unsustainable trajectory with respect to total amount of debt and deficit spending over time. There's going to be a bill passed this year through the House and through the Senate in the United States, which will have even increasing amounts of deficits. And so this will be the kind of talk of the town, so to speak. And it's supporting kind of assumptions that people have today and market expectations they have today about rates being higher for longer. We'll talk about that a little bit. The second one is AI, and you can't get away without talking about this. It's critical for a lot of the investments in our portfolio. A lot of people going into the year thought AI might be overhyped, but the infrastructure constraints are kind of binding, and everyone wanted to invest in power assets and data centers and all these sort of things. Now, I think the AI is just more question marks than that, meaning some of those stories are working, some of them not. But people are starting to see AI actually create value in other types of companies. So particularly in public and private enterprises where there's a margin opportunity associated with AI. And that's a lot of the conversation. That could be very, very good for private equity as long as their cash flows aren't disrupted by it. The third one, strong U.S. consumer. If you went into the year earlier in the year, everyone was talking about how great the consumer was. The high-end consumer was resilient and it would kind of backstop demand overall in the marketplace. So the strong U.S. consumer, and the expectation was sort of the lower income consumers would have some challenges, but the higher income consumers were doing well. Now you have a weakening consumer across the board. So the high-end consumer has cracked, and that's global. That's not even just the U.S. It's sort of happened globally. And then at the same time, the low-end consumers are really suffering. The U.S. has just instituted repayments on student loans, which are a large source of kind of debt associated with some of the different people in the households in the United States. And about 7 million of them are about to see their credit scores go down for the first time in years as a result of non-payment. So a lot of headwinds facing the US consumer. US insectualism. So if you had gone from the kind of COVID period through the beginning of this year, the US equity markets, public, private markets all outperformed the rest of the world pretty considerably over that period. That is completely reversed. So, as everyone sitting in Australia is looking at this, they would know the US currency is down, US asset values are down versus the rest of the world in terms of index performance. And so there's been I don't know what you would call it, but a lack of support or a loss of some confidence in the reliability of the US markets, probably because of some of this regulatory uncertainty, policy uncertainty, and just noise generally coming out of the political environment in the United States. And that's caused people to kind of reevaluate their exposure. And I think on the margin, trim exposure to the US dollar, trim exposure to US dollar assets. And then finally, the tariff risks are a giant kind of question mark. So I have some slides on this. Meaning everyone went into the year thinking that tariffs were noise. They were kind of political noise, and that there would be some tariffs, but they wouldn't be that substantial, and they wouldn't affect key trading relationships. And they'd be used strategically, right, to sort of build up things like pharma development in the United States or certain key supply chains for the military. And instead, we had an announcement on what was called Liberation Day of existential tariffs that were meant to extinguish trade and the flow of commerce between the United States and other countries. That was quickly undone, and the market started to recover, but there's been real damage from the fact that they were even threatened. The idea that people thought that existential tariffs were a good idea is not going to be forgotten anytime soon by kind of market participants. And there's a lot of anxiety around it. And we still have unknown and unknowable risks associated with tariffs, kind of at this point, based on where they'll settle out. There's a lot of negotiations going on. There's a lot of noise. We would have seen an announcement today about kind of a resolution supposedly between the United States and China, but we had heard the same thing a month ago. So, we'll have to wait and see where that comes out. The big picture of all this, you have heightened risk of recession, which is a negative, and you have a lot more uncertainty, which is a negative, but you've got a big long-term positive, which is AI, starting to creep into the private equity sector and really benefit the companies and the assets in the sector. So it's kind of a confusing time, but I think for the long-term good, in the short term, there's some volatility one needs to manage through and be cautious about. If we go to the next slide, Corey, I'm not going to spend time on all of them, but this is just an illustration of the tariffs, where the tariffs were on Liberation Day and where they were announced, where they are today following kind of what the rules are, and then you see the year end of 2024. So you'd still be at kind of the highest tariff since essentially the post-World War I period. So pretty considerable even as they are today. And we don't really know where this will settle out. We looked through the portfolio and did analysis on every holding in the trust. And thankfully, only 1 or 2% of them seem to be in what I think of as a red category or negatively associated category with current levels of tariffs. And I think there's some decent chance there'll be some evolution in the tariffs that'll help improve that situation even for those companies. And so it ended up not being a substantial negative for the portfolio when the tariffs were much higher. Kind of the effective tariffs, in the beginning of April, you would have seen more damage to the portfolio, kind of as a result of those. But thankfully, that's not where the tariffs are settling out. If you go to the next slide, Corey, it'll just illustrate what I was talking about, the shock in the markets. So it has been a really interesting year. This is just using the S&P 500 as a proxy. And obviously, rest of world was much better. But in the US, the S&P 500, kind of the bedrock indices to track at least global equities, you can see there's a drawdown of, essentially +5 to -15. So therefore 20% on the announcement of these tariffs. And you've recovered most of that at this point in time. You're kind of back or getting close to, back to where the peak market was before that environment. But that's a lot of damage. That's a lot of volatility. It's a lot of uncertainty, and it's kind of the talk of a lot of markets. And I think it's going to continue to be true that particularly people who are not forced to be exposed to U.S. assets will on the margin be kind of less excited about them. If you go to the next slide, Corey, this shows the differential in the markets. And there's got a lot of interesting things on this slide. Obviously, you can see what I was talking about, that the rest of the world has outperformed from a market perspective, the US markets. I think you could see something very interesting in the fact that things like Bitcoin and gold and other assets that don't have an inherent productive cash flow, meaning they're by definition kind of a speculative asset. Their value is determined by just the supply and demand associated with the trading for them, as opposed to the cash flow that comes from them, of which there's none. Those assets have rallied a lot, and I think that's largely based on concern about fiat currencies and the U.S. fiat currency system associated with debt, which is, I think, very interesting. I think it's not a good sign. And Bitcoin, I'd probably put in a different category because it has different applications, different user base, etc. The fact that gold is rallying so much is, I think, a little bit of a real negative sign for confidence in the traditional fiat system, for example. The next slide, Corey, just the uncertainty I was talking about. This is an index that gets produced by Bloomberg. It draws together a lot of different market kind of measures of things like option pricing and other types of things to sort of measure how much expected market volatility and uncertainty is priced into the value of those options and other instruments. It is as high as it has been in most people's investment career. So if you look at the graph on the left, you'll see the uncertainty in the markets right now in terms of economic policy uncertainty is off the charts versus people's career. And then, if you look at the right, you'll see in April, we had a real pickup in the VIX associated with that market volatility. And now it's kind of settled back into more normal levels, at this point in time. So the uncertainty remains around policy, but the markets are at least a little bit more calm at this moment, but they weren't for a period of time there. If you go on to the next slide, Corey, I think we start talking about how does this translate to private equity? What does it really mean? That it means the realization environment didn't come to fruition the way people hoped. Companies continue to perform, economy continues to grow, valuations in the broader markets are kind of flat, year on year right now in terms of what's happened, because you had to recover from those drawdowns in the public markets. The private markets didn't experience the same level of drawdown, and we didn't see, as I mentioned, a substantial impact, at least on our portfolios, from the tariffs. We're happy to report we're actually having kind of an unusually large amount of realization activity in the portfolio, and things seem to be performing pretty well. Corey will go through that in more detail, when we get there. But at the end of the day, we exist in the context of kind of valuations, and so I think these are important. My word of warning for everyone is just, even in the context of what seems like maybe it wasn't a benign period, the market's not particularly cheap. And we talked about on the last couple of these, webinars. So, we have a slightly higher elevated risk of recession, and markets are not particularly cheap. High yield spreads are pretty compressed, as you'd see on the side. That's not a good setup for taking a ton of risk. And so, we've talked in the past about how we've tilted the portfolio to a defensive posture in terms of the types of companies and the nature of the risk, the leverage profile, et cetera. We continue in that kind of defensive posture, overall in the portfolio. If you go to the next slide, Corey. This is a slide we'd like to show, which is just, and we get asked all the time, which is, well, how are private markets faring versus the public markets in terms of valuation and margin of safety? I think what you'll see here is a very substantial margin of safety compared to the public markets in the private markets right now. So the discount that is available is, pretty substantial. It depends on what metric you're using or what year you would look at, but we would actually say this is a higher than average discount for private market assets versus public market assets today, that's a good setup. And you're starting to see actually things like IPOs in the portfolio, which Corey will talk about as a result of this. People are starting to arbitrage between the two markets, and the public markets have become a viable exit mechanism because the valuations are so much higher than what you would see in the private markets today. The middle market, where this portfolio is positioned, and we've always talked about how we do it, it just remains very, very attractive for all the reasons that we talked about, and particularly because the leverage levels are lower and the purchase price or the valuations are lower. The historical returns we've seen have been pretty consistent over this period, and there's not a lot of financial engineering going into these assets. I think, one of the things we note is in private equity over the last couple of years, the quality of what people did really got tested. When you had the GFC in 2008 and 2009, rates went to zero. There was probably a 10-year period there where You had private equity practitioners who were really thoughtful about acquiring companies and working with founders or partners, or having operational plans to increase cash flow and maybe merge or change the way companies drive their business, drive those cash flows. You had other people who were just buying things, putting a lot of leverage on them, and benefiting from margin expansion that was a result of that, or are benefiting from multiple expansion on the exit. It's hard for a lot of the market to discern the difference between those two things, kind of a high quality return and a lower quality return. If they both look the same, the IRR is 18% and the multiple's 2x, the market became a little less discerning about the difference between the way in which people were generating those returns. I'll tell you, the scrutiny is back. People now are holding funds and holding sponsors to account for how they generate that value. That's kind of always been true in the middle market, where you have much more specialization, and there just isn't the same opportunity for financial engineering, even if the markets were, attractive for it. And we're kind of happy to see it, actually. So I think it's been benefiting our sponsors in terms of acquisitions, purchase price, etc., and really it looks good in terms of forward expecting return, because you're entering in a much better place and there's less competition for those assets. The next, I'm going to skip it, Corey. It just kind of makes the same point on the fact that the small and middle market kind of outperformed. Before I turn it over to you, Corey, to talk about the portfolio update, the only thing I kind of wanted to say, overall, we get asked a lot about when is the private market activity going to pick back up. We don't know, is what I'll say. When Corey goes through, he's going to give you good news about this portfolio and how our assets have been maturing and how we've been able to generate cash. We've also been able to explore certain options for the portfolio in terms of realizations and maybe accelerating realizations in the portfolio at NAV, which is fantastic. And the values are holding up and the companies are holding up. But if you looked over the last 2 or 3 years, it hasn't been a fantastic time for private equity. The markets as a whole are growing at kind of mid-single digits, and you've seen that evolution in the NAV of kind of these funds. The last 6 to 12 months have been better. The forward expected returns on the assets are much better, because obviously if you buy things at better valuations, you expect the corollary to be higher returns. And so, we feel very good about how the portfolio is positioned. But with that, Corey, I'm going to turn it over to you for the portfolio update, and then we'll come back on for questions that you and I will field at the end.
So this first slide provides a high-level overview of PE1's current portfolio allocations. As we've talked about in the past, the portfolio is broadly diversified. Currently have exposure to over 100 funds and nearly 650 portfolio companies, with vintages dating back to 2003 as a result of our activity in the secondary market. At this point, we've committed $530 million to investments, nearly 80% of which has been funded, and we have seen meaningful distributions from those investments. PE1 has received over $150 million in proceeds from its investments through the end of April. About 40% of that has been distributed over the last 12 months. Drilling down into the portfolio a bit, we have invested in 16 primary private equity funds managed by 13 different sponsors. The portfolio currently has exposure to 90 co-investments and directs, and around 40 secondary transactions that themselves are providing exposure to more than 350 companies, and giving the portfolio significant backward vintage year diversification, which, as we've discussed in the past, is an important portfolio diversifier and a risk mitigation tool. From an implementation method perspective, our equity co-investments and direct sleeves, the largest portion of the portfolio at 64%, and that's driven by a number of factors, including performance, and that our most recent commitments of size are to our multi-asset class and middle market buyout co-investment implementation tools that are finishing out their investment periods over the next 6 to 12 months or so. The equity funds portion of the portfolio, which contains our primary and secondary fund investments, also continues to grow as our primary fund managers deploy the capital we committed to them over their 3 to 5 year investment periods, and we execute on more secondaries. Our private credit portfolio continues to ramp as well. We've already executed on 29 senior credit investments that are benefiting quite nicely in the current market environment. 8 of those have already been realized. And then overall performance for the portfolio of underlying investments continues to be strong. We're generating a 16% net IRR since inception and a 1.6x net multiple. As I will show you in more detail in a couple of slides, realizations are ramping nicely, and we currently expect them to ramp pretty meaningfully over the next 12 to 18 months. Slide 16, we've shown this one before as well, provides some more detailed exposure information on the entire portfolio across a number of different metrics. From a sub-strategy perspective, 61% of our overall portfolio is comprised of leveraged buyout investments, with approximately 2/3 of that buyout exposure in the middle market for some of the reasons Fred touched on a couple moments ago. We also have some exposure to growth within the portfolio, both directly, only about 8% of the portfolio today, or where possible through investments that included structural elements designed to enhance the performance profile, which is much of the structured equity portion of the portfolio. As I mentioned in the past, these elements typically include a component of potential downside protection through a use of a variety of different instruments and terms, things like preferred equity and liquidation preferences. Given the significant repricing we saw in the growth space in 22 and 23, pretty happy about our strategy of generally targeting those types of investments with those structural protections. One other thing I'll remind people about with respect to sub-strategy exposure, that you don't see any venture capital investments in the portfolio. That is because VC allocations are not a part of the strategy that this vehicle pursues. Geographically, the fund is a little less than 80% invested in North America, has more limited allocations to Europe and Asia, and that too is generally in line with our targets, though I could see the European exposure continuing to inch up a little bit as market and geopolitical conditions in the region improve. And then from an industry perspective, portfolio is quite diversified. Industrials make up the largest portion at 22%, and several other sectors, including IT, financials, consumer discretionary, and healthcare, each comprise a little over 10% of the portfolio. All told, though, we are highly diversified by sector, which is really by design. So as promised, this next slide provides some detail on capital activity within the PE1 portfolio from inception to date, and what we currently believe it may look like through the end of 2026. Not surprisingly, the heaviest deployment period was during the first few years when we were really ramping up the portfolio, peaked in 2021 at a little more than $115 million, due in part to Project Rambler, which was the large, well-performing secondary completed that year, as well as the general ramp-up in activity by our early commitments, many of which were quite cautious and deliberate with respect to deployment during the early days of COVID. You can see a pickup again this year in terms of capital contributions, which really all relates to commitments we made over the last few years to our multi-asset class and middle market buyout co-investment implementation tools, as well as to our secondary fund, GSF3, as we prudently brought PE1 to full deployment over the targeted ramp-up period. Future commitments will be made in the ongoing effort to maintain full investment, with our next commitment of size not targeted until sometime next year. Looking at the blue bars, you can really see a significant and steady increase in distributions as our early investments continue to monetize their positions. I would not be surprised to see if the investments we made in our multi-asset class and middle market buyout co-investment vehicles right after launch in 2019 return, say, 50% or maybe even a little more of the $136 million we invested in those vehicles, with potential exits coming for positions like Instacart, Blue Triton, Gainwell, Core Specialty, Spice World, Inifis, and that's just to name a few. Some of these companies have already begun sales processes. We have also started to see meaningful realizations within our equity funds. For example, Project Rambler, which is the secondary I mentioned before, that continues to be a cash cow. It's distributed more than $2 million in 2025 already. And one of our HIG primary fund investments, that fund has distributed more than $1 million in the last 6 months in connection with a few realizations and a dividend recap. Just some examples of the real pickup in distributions we are seeing across the portfolio as our investments have matured. So as I've done in the past with these webinars, I'll use this slide to really talk about the different investment sleeves and then provide an update on performance and some of the more recent developments. As you likely know by now from these discussions, there are two different tools we use to execute nearly all of our equity co-investments and directs for the portfolio. Our multi-asset class fund and our co-investment opportunities fund. Collectively, these investments have performed well. They're generating a 16% net IRR and a 1.7 times multiple from inception through the end of April, even with MAC3 and GCF3, our latest versions of those vehicles, actively deploying capital into new investments over the last 2.5 years. Equity co-investments and directs, they make up nearly 2/3 of the portfolio today, and they are performing. Over the last 6 months, this portion of the portfolio increased more than 10% in total value and accounted for a substantial majority of the increase in investment value within PE1's private markets portfolio over that period. So now I'll touch on a couple of those investments and some of the underlying companies. So we've committed $75 million to our co-investment funds, the ones that target middle market buyout co-investments, predominantly in North America. Our first investment in the strategy was a $53 million commitment to GCF2. That portfolio currently includes 15 investments, well diversified by industry, geography, vintage year, and sponsor. Portfolio has 8 full realizations and 8 partial realizations to date, with those investments generating more than a 2.5 times return to the fund. The most recent realization was the redemption of our structured equity investment in Uber Freight, closed in October, generating a 1.6 times multiple. We have also begun monetizing our position in Blue Triton in earnest. And I'll stop on that one for a second, since we have exposure to that investment across a couple of different vehicles, and it's the third largest position in the portfolio. So Blue Triton, this is the former Nestle Waters business. They're a leading provider of several longstanding bottled water brands sold in the US and Canada. When we invested, it was a carve out of an undermanaged business with a market leading position in a very resilient category. Revenue and EBITDA are up triple digits since our entry, driven by strong end market demand, cumulative impact of a number of modest price increases, and the successful execution by our partner here, a firm called One Rock, of a number of key revenue growth and operational initiatives. Blue Triton merged with publicly traded Primo Water in an all-stock transaction that closed in November. In connection with that merger, they distributed 37% of investment costs. Since then, we have really started to monetize this position. And to date, inclusive of a couple of dividend recaps they previously did before going public, we've already received about 4x of our invested capital in the company. There is still significant value remaining in this investment that we currently expect to be realized across the next 12 months or so. The remaining investments in the GCF2 portfolio are performing quite well. All but one is marked above a 1.25 times multiple. And all of that is really helping to drive a very healthy 24% IRR and a 2.2x net return to PE1. And the fund has returned more than PE1's cost capital into the fund, which has helped the fund to be a top performer both in the PE1 portfolio as well as when compared to its peers in the market. More than half of the remaining investments are currently marked above a 2x, 4 above a 3x, and that includes Blue Triton, Osaic, which I'll talk about a little bit later, and a company called Mailer, which makes protection equipment in Germany, and they've already returned cost that is currently marked above a 3.5 times multiple. Overall, that fund's total value was up about 4% in Q4, and we're expecting it to be up another 3 to 4% once our 31 March valuations are finalized and roll through the NAV. P1 has also committed $22 million to GCF3 in June of 22. That fund committed to 19 investments thus far alongside 14 different sponsors, and that portfolio is currently marked at a 1.2 times cost. Although it's still quite early in the investment period, we're pretty happy with the level of diversification with the fund and the quality of the assets we've been able to purchase, many of them at much more reasonable multiples than we were seeing in the market over the last couple of years. About half of the deals purchased were at an entry multiple below 10x. All but one of the investments is expected to be marked above cost once our 31 March valuations roll through. And as a whole, the portfolio is expected to be marked up around 3% quarter over quarter to a 1.3 times multiple, with a number of early winners and even some early distributions within the portfolio from some dividend recaps. Our other large investments are multi-asset class strategy. They're committed now to 2 funds, 186 million, and that vehicle tries to just be very tactical and take advantage of opportunities wherever they present themselves in the different parts of the market cycle. Our first fund, MAC2, fully invested, well-diversified mix of strategies, sectors, geographies, and that has all helped the fund to generate a 1.7x net multiple to PE1 through the end of April. Fund has already returned just under 30% of invested capital to date, and we expect realizations to ramp meaningfully over the next 12 months. Few of those are likely to include online grocery delivery platform Instacart, which has the potential for a full or partial realization in the near future, assuming the valuation holds, Blue Triton, which I just mentioned, and SpaceX, which we believe there will be opportunities for a secondary sale in the near term. In fact, we completed a small one last year. In fact, to SpaceX, as we communicated in our newsletter late last year, their valuation hit $350 billion in December based on a secondary share sale. And we are hearing that there will likely be another tender soon that will result in an even higher valuation for the company. Our newest multi-asset class fund, MAC3, invested $1.4 billion in 35 investments. They also continue to perform well, with early winners helping the fund have no J-curve since launch. As of the end of April, that fund has generated a net IRR of 16% and a 1.5 times net multiple, up 8% in total value in 2025 and 17% over the last 12 months. One investment that's really driving that performance in that fund, although there are many, is a company called Kroll Bond Rating Agency. Kind of a boring company. It's one of 6 full-service global credit rating agencies in the world. We were able to acquire that company at a discounted valuation relative to its peers, which are the likes of Moody's and S&P, due in part to the very strong income positions of those peers. That business is really benefiting nicely from the recovery in securitized product issuance, where they have significant market share. And despite their strong recent performance, they still are marked at a meaningful discount to those public competitors, which we think creates some really nice additional potential upside over time as we get towards realization. That one's marked at a 2.5x, up more than 10% since the beginning of the year. So we feel pretty good about where that one is. MAC3 also has sizable exposure to SpaceX that obviously continues to perform well. And some of their recent investments, things like Brightview, which is a commercial landscaping company in the US, are all performing well, somewhere in the 1.5 to 2x multiple. The equity funds sleeve in our portfolio is comprised of our secondary transactions and primaries, committed 124 million to 7 secondaries. 65 million of that was committed to GSF3, which is an implementation tool that provides investors like PE1 with a single point of entry to a portfolio of secondaries. That fund has done 37 deals, a nice mix of traditional LP secondaries and GP-led deals, and the LP deals on average have been purchased at pretty attractive discounts to NAV of around 22%. Fund is now 80% committed, and it actually made its first distribution to investors early this year, returning nearly 20% of invested capital. We've also committed 59 million to 6 standalone secondaries. Those are what have provided PE1 with most of that significant vintage year diversification. There's funds in there dating from 2003 to 2019, and they have early net returns of 38% and a 1.7 times multiple. Much of that is on the back of that large diversified deal I mentioned before, Project Rambler. We purchased that at a really great discount to NAV of just over 40%. That investment is generating a 2.1x net return to PE1 to date, and it's distributed more than 150% of our capital. Within our primary sleeve, we've made commitments of 94 million to the 16 primary private equity funds, includes 12 MMBO funds or middle market buyout funds, 2 growth funds, and 2 special situations funds from 5 different vintages. Most of those investments are now substantially invested, about 80% of their commitments. We're generally pleased with the early returns, with the funds generating a 13 to 14% net IRR at a 1.4 times net multiple. A number of early winners in that portfolio are value investors like Peak Rock, HIG, and Winchurch, who focus on operationally intensive investments in stressed or distressed companies. But there are other strong performers like Riverside Microcap Fund 5, which, as its name suggests, invests in microcap companies. That fund has deployed 95% of its commitments to a portfolio of 13 platforms. They've done 50 or 60 add-ons, and they're generating net returns of 16% and 1.6 times multiple to P1 as of the end of April. Last but not least, since we launched our private credit strategy a little over 2 years ago, we focused on investing with high-quality sponsors, cash flowing, defensive businesses. We still continue to be active on the corporate side. We are seeing really great relative value in the asset-backed space. There's a little less competition for deals there as a result of potential for higher risk-adjusted returns. Our investments are performing really well. They're delivering 10% plus net returns at PE1 with no issues across any of the 29 deals we've invested in. As I mentioned before, we've already realized 8 of them. Now, Fred touched briefly on tariffs and some of the work that we've done. When they were announced back in April, we immediately began assessing our portfolios for impacts. Fortunately, or perhaps unfortunately, I suppose, we developed a pretty thorough and repeatable process for doing these types of assessments during COVID, which was refined after the Silicon Valley Bank collapse in 2023. So what we did right after the announcement, we began working closely with our sponsor partners to evaluate whether there were any investments that were at high risk of significant impairment in value as a result of the tariffs and the resulting market volatility. For any companies we identified as potentially at high risk, we implemented enhanced monitoring, which results in frequent communications with our managers about those companies and information around the strategies being implemented by those companies to mitigate risk. Given the very fluid nature of the tariff situation, it's been a pretty dynamic process that requires regular reassessments that we expect to continue for the foreseeable future. As Fred mentioned, happy to say that a very small percentage of our portfolio is deemed to be high risk, less than 5%. And overall, we believe the overall portfolio is at low risk. Most of the companies that were at high risk were those that supply chains that were most reliant on China. And I think it's important to point out that in our initial investment assessment, we listed SpaceX based on a number of factors, including the fact that its equipment costs would likely rise as a result of the tariffs, and the fact that the company was owned by Elon Musk, and given his involvement with the Trump administration, there was fear of potential foreign retaliation. That hasn't materialized, so we downgraded the investment risk, though we continue to obviously monitor it closely. I'd say ultimately, we think that the diversification, the fund's focus, and our sector exposures provide us with some pretty defensive positioning in the face of potential tariffs and trade uncertainty. Certainly not going to be immune from second-order impacts. We do think it's well positioned for success, given its focus on North American middle market sponsors. And there are a couple of reasons for this. First, middle market businesses are often not reliant on global trade for value creation initiatives. Middle market managers have more tools at their disposal. Things like spending time really just professionalizing the family-owned businesses they are purchasing, domestic expansion and industry consolidation. Additionally, many of the portfolio companies have local or regional customer bases, supply chains, and end markets with a substantial focus on domestic sales and manufacturing. Also, as Fred mentioned, we've been focused on companies operating in end markets that have resilient demand drivers and strong secular tailwinds, as these are the types of businesses that are most likely to succeed in times of market uncertainty. So we've been pretty conservative about the types of investments we've been looking at. All told, though, we feel pretty good about where PE1 stands today from a global tariff perspective. Next slide shows our top 10 positions. Quite diversified with exposure to nearly 650 companies, and only one investment, SpaceX, represents more than 3.5% of the private markets investment portfolio. Most of the investments on this page have achieved their weighting through a combination of strong performance and the fact that they sit in multiple portfolios. I'll just touch on a couple of them, as I want to make sure we're leaving time at the end for questions. One of them, the second one on the list, Gainwell, I believe we've talked about them before. They're a technology provider. They work with healthcare or health programs throughout the US. They help with things like claims processing and recipient eligibility management. Since our investment in October of 2020, so about 4.5 years ago, both revenue and EBITDA have increased over 75%. They recently signed an infrastructure outsourcing agreement that is going to drive material cost savings. And they recently appointed a chief AI officer to accelerate their advantage in driving innovation, efficiency, and competitive advantage. That investment is marked at a 2.6 times multiple, and we think there's a good potential for an exit at some point in the next 9 to 12 months. One more I'll mention is Osaic. They're the fourth one on the list. They're one of the largest networks of independent wealth management firms in the US. They provide financial advisors with things like tech support, regulatory and compliance support, and the like. Since we entered that one in the summer of 19, that platform has made a number of accretive acquisitions. They've realized significant synergies, and they've helped pro forma EBITDA increase more than 3x since our entry. Assets under advisement increased more than 25% during 2024, and the company has realized significant cost synergies following the successful integration of their most recent acquisition. That investment's marked above a 4x at the end of last year, and I would expect it to be marked up to a 4.5 to 5x once our 31 March valuations are finalized. Looking at how we benchmark, and we've shown this slide before as well, we'd like to include it to show the progression of the private markets investment portfolio from a performance perspective, and how that performance compares to both an industry benchmark represented by Burgess, which is one of the most widely used benchmarks in the private equity industry, as well as to the Russell 3000 and the MSCI World. As you can see on the slide, over the last 4 calendar years ending 31 December, our since inception returns have exceeded both the Burgess upper quartile and pooled returns, as well as the public market benchmarks. So we feel pretty good about how things have been shaping up. I'll spend 1 minute on what we're seeing in the current market environment and then talk about the NAV and then open this up. So where are we seeing opportunities? Within the buyout side of things, we believe the middle market investors should be able to continue to benefit from the more normalized valuations we're now seeing in the market, and we're seeing that come to fruition in our co-investment activities. We also think that given the current cost of debt, middle market managers who typically use less leverage are poised to be more successful. We think that managers that operate in this part of the market will likely have lower exposure to tariffs given their lower reliance on global trade or M&A to effectuate their value creation initiatives, as I noted before. With respect to special situations, although we don't try to time the market, we think that sector, particularly credit funds and those that make distress for control investments, will continue to benefit in the market. The recent and continuously evolving changes to US global trade policy could result in inflationary pressures, which will create some interesting restructuring opportunities due to the high interest rates that continue to persist. As we discussed in the past, a number of PE1's partners are cycle-tested value investors that we believe are well positioned to benefit in that kind of an environment. We continue to be cautious these days on the growth front, though attractive opportunities do exist. Manager selection continues to be absolutely critical given the significant dispersion between the top and bottom performers, and it's essential to be investing with cycle-tested managers. PE1 doesn't invest in VC, though I will note that there is a sentiment among seasoned investors that the valuations of VC-backed companies have yet to bottom out. We're still quite bullish on North American opportunities, continues to represent the lion's share of the private equity market. Deal flow volume increased during 2024 over the prior year, and Q1 2025 was pretty strong. The tariff activity and market volatility has slowed the deal environment a bit in Q2. And with respect to Europe, while US trade policy has caused uncertainty, we remain optimistic that lower inflation, anticipated future rate cuts, and fiscal stimulus in Germany will enable an interesting deal activity there. So we're getting cautiously excited again about potential opportunities in Europe. And then with respect to Asia, many LPs, including ourselves, remain particularly cautious. And while some interesting opportunities do exist, We expect it will remain a small part of the overall PE1 portfolio. Looking at NAV performance since inception, we've generated an annualized return of 9.5% since inception as of 30 April, which is within the targeted return that was established for the fund at launch. We feel pretty good about that, particularly given the challenging market conditions we've had for private equity, both during the pandemic and over the course of the last 18 to 24 months, excuse me. Now that the portfolio is fully ramped and the managers we have partnered with are really beginning to see the fruits of their value creation initiatives, we have seen strong performance over the last year. NAV per unit increased 9.1% over that period, and we currently expect to see uplifts in valuations on exit for many of the companies we believe could be sold this year or next, which should have a positive impact on the NAV going forward. With that, I will turn it over to Adam to talk for a moment about the Buyback Initiative, and then we'll take some questions.
Right, thanks, Corey. So I'm going to keep this brief and to the point. Somebody else, I'm not mentioning any names, went a little long. But right now, the units are trading at an unacceptable discount. The portfolio itself is in good shape. We believe that valuations are completely reasonable. I speak with investors and potential investors all the time, and there's no broad concern about the quality of the underlying assets or the way that they're being valued. But that said, I'm still going to dig into valuations a little bit more with Fred during the Q&A, because I want everybody to be completely confident that the discount has nothing whatsoever to do with the fundamentals of the portfolio. What we are dealing with here is a supply-demand imbalance. It began during that extended period when the NAV was relatively flat, and now it's being compounded by factors that have very little to do with the actual investment opportunity. We think that one of the biggest reasons is actually this move to managed accounts. As a total vehicle NAV, PE1 is about $420 odd million, and it's generally considered too small or too illiquid to be included in these big model portfolios. And we know of advisors who are transitioning their businesses to managed accounts, and they are offloading PE1 units as part of the rebalancing process without really giving too much thought to the investment merits or market implications of doing so. So, as I've already said, I chat a lot to advisors. I'm talking here about the kind of people who look for opportunities, who still have discretion, and who still create bespoke portfolios for their clients. And the overwhelming response is that they have interest, but understandably, they are also hesitant to commit early when there is this big backlog of sellers. They all want to buy the last million. So if only it was that simple. As Corey mentioned, there's a lot of cash movement within the portfolio. We've got capital being called by the managers to whom we've made commitments, and at the same time we're receiving cash and distributions and sort of realizations back from our existing investments. And so at the moment, these flows are broadly in balance, and that's why we haven't been buying back very much, and it's had very little impact so far. The expectation is that by the end of the year, there will be a lot more cash coming back into the portfolio than what's going out. And we've told the market that we will use that cash to buy back units. The bigger the discount, the more we will buy. And if we can accelerate that process, the process of freeing up cash in the portfolio, we absolutely will. We're currently looking at ways to do that because the buybacks are immediately accretive to the underlying NAV. So what that means is that unit holders will benefit both from the discount narrowing and the uplift to NAV. So I hope this clarifies our thinking and reinforces how seriously both Pengana and Grosvenor are taking this issue. We are fully prepared to materially reduce the value of our asset base if that's what it's going to take to generate the right outcomes for our clients and allow normal balanced trading to resume. So I'm now going to move on to Q&A. Fred and Corey, if you want to switch on your cameras, that would be great. And Fred, as promised, I do really want to dig into valuations a little bit more. What gives you confidence at the moment that our NAV is appropriately marked?
I think there's actually probably three things that I would say. So the first is just the performance of the underlying companies. So meaning the most important thing is when you go through the underlying positions, whether they be funds, whether they're individual positions, and you roll them up, the businesses are all performing quite well. And if you looked at the multiples and you track those multiples against public companies, obviously it look like a huge discount, and you track it against other private holdings and the multiples at which things are transacting in the marketplace, it's in line with kind of your expectations there. So that's kind of the first one. I think the second point I give is that what Corey tried to highlight, in kind of his piece, I think you tried to highlight in your comments, there's just a lot turning over in the portfolio constantly, and meaning buys and sells. And if you really ripped apart the portfolio, there's a significant percentage of it transacting at any point in time. There's a lot of public holdings even in the portfolio, which is meaning they could just be sold tomorrow and liquidated into the public markets at the NAV. And then the third, I'll tell you, is just we obviously have looked at the discount to NAV, looked at the different things that you could do with the trust in conjunction with Pengana, and we pressure tested obviously some of the valuations from different assets and what those might trade for example, in a secondary market and otherwise. And the good news is they trade at NAV, meaning they are kind of tradable and tradable. So there's options related to that, which, if this situation continues, we can kind of turn them into cash and then accelerate things like buybacks and do other things across the portfolio. So I think it's all of those things that kind of gives me, kind of the confidence. Obviously, there's a whole valuation process that isn't just our valuation; it's the valuation of the sponsors as well. But the market forces are what ultimately determine kind of the value. And I wish there was a way to elucidate this and show people that, meaning if we I wish there was a simple way to sort of light up all the individual pieces of the portfolio and then highlight where the valuation was derived and then how it adds up to the NAV, because I think something gets lost when you aggregate, Adam, to a large extent. But that's why there's kind of confidence in the portfolio. It will come out over time. I mean, is that simple? Like, meaning ultimately the value gets realized in all of these holdings, and it's happening every year. Over the next couple of years, you'll have more than 100% of the current NAV returned to cash. And some of that will get reinvested, obviously, and some of it will be paid out and some will go to buybacks, but you'll have literally the entire portfolio produce a 1x over that period of time. And maybe those types of things will be the things that drives confidence, kind of around that for people.
And Fred, can you comment on how many holdings or funds are not performing at the moment, and perhaps compare this to what the experience was like during COVID? I mean, Corey, I think you'll probably have stuff to add here as well.
Yeah, I mean, look, it's a good question. It's not performing. Obviously, what that means matters a lot. So, meaning, we have certain expectations when we go into making every investment. A certain fund, if we made the investment, we probably were expecting top quartile performance. And what that means for us, I'm sort of like, think it was an 18% IRR and a 2x multiple or something over its life. And there's different ways, for example, that fund could disappoint. It could disappoint on the return. It could disappoint on the pace of that investment. It could disappoint on the pace of the realization of that capital, even though the returns are in line. When it comes to the individual companies, there's kind of two ways for them to disappoint. It's either the operational performance while we're holding it, or it's we go to sell and we don't realize the value we were hoping for, kind of in the portfolio. Those are all the different ways that you kind of could have disappointment. Right now, I mean, it's sub 5% of the assets in the portfolio would be disappointing to plan, if that makes sense. Like if you looked across all of it and sort of tracked it. Now, for a lot of the funds, those are early. They might be early, and so it's about getting the capital deployed. You don't have kind of all the proof statement around this. For the individual companies, of course, you're much later. Once you've bought them, you have an operational plan. You're years into the management. There's more immediacy to that, and so it's probably more meaningful. If you looked back to kind of the COVID period, or we obviously had more companies underperforming during that period of time. There's just more things that were affected from a revenue perspective during that environment than the current environment, although it wasn't very severe, when we were building up a portfolio at that time. If you went back all the way to our private equity experience in, say, 2008 or 2009, which is probably the last true large-scale global economic shock, even there, the number of companies that were truly underperforming was probably sub 10%. But you obviously had valuation disappointments. When the markets fell by half, your plan in terms of valuation and realization wasn't realized. You ended up holding things longer than you expected. So we would have been much higher, percentage of disappointment in the portfolio at that amount of time. You might have had a quarter of the portfolio below your plan, either in terms of its performance or its valuation at that point in time. It's always a little bit better in the public markets just because these things are more resilient and longer term. You have more time, right, to kind of enact and kind of realize on the plan. Plus, you have no forced sellers next to you, right? We don't have a 10% holder of our private equity interest who is going to panic in 2009, which would affect the valuation. You just don't have that in terms of what's going on. But I think it's pretty. I don't know, Corey, kind of, you want to provide any kind of color, but I actually think it's pretty muted at this point.
I think Fred's right. And just two things to add. I'd say if you were to look at individual positions, not surprisingly, the very small allocations to growth funds have been a little more challenged. But they, after performing negatively as technology valuations reset kind of in 21 and really in 22, they're all producing positive returns now. So it's going to take us a little bit longer to get to the returns that we were seeking when we underwrote them originally. But we think they'll get at or close to that. And I suppose because of COVID and some of the other shocks to the system, holding periods have probably elongated a little bit, which would degraded IRRs a bit. The total value in those companies continues to remain strong. It hasn't reduced. And with a lot of the realizations that we're seeing coming now, we should be able to start bringing that IRR up a little bit more too. I feel pretty good largely about what we're seeing across the portfolio.
Okay, great. Thank you. There's obviously a sort of economically divergent views in the US at the moment. There's Trump putting pressure on the central bankers to lower interest rates quite sharply. There's inflation, expectations from the big, beautiful bill. How would you expect private equity in general to perform in a higher for longer rate environment?
Yeah, maybe I'll take this one, Corey, and you can chime in. Realistically speaking, rates have been high for a while, and the market's been pricing in high rates and rates staying high for a while. So that's not a new phenomenon. I think sometimes you periodically get the market getting excited and starting to price 4 or 5 rate cuts. That's kind of gone away. Right now we're pricing in the US, at least the forward market's pricing 2 rate cuts this year. I don't even know if that'll happen, meaning that's probably, I don't know whether the market's being aggressive or conservative kind of on that. Any way you cut it, there's nobody who's projecting inflation to drop below 2%. And so it's really hard to envision a world where rates aren't normal. And by normal, I mean 3 to 5% on the long end, right? In terms of what's going on. And we're kind of at the high end of that. That hurt private equity performance for the last 2 or 3 years. There's just no question. At the end of the day, they're levered equities. The cost of that leverage went up. The multiples went down as a result of that. But we're completely through it. It's why you went for kind of a 2-year period or 2.5-year period where the private equity as a whole, the entire industry delivered kind of a 4 or 5% return. During that period. And you would have seen that in the NAV evolution of the trust, a very similar number over the 3-year period, but you're through that now. The multiples are lower. I think rates can't really go much higher is the truth. So if, let's say the 30-year was 6 or 7%, you're going to have a recession, a very severe recession. And then you're going to have rates come off naturally as an adjustment cycle associated with that, because we have a very levered economy. Both the private sector, the corporate sector, and the public sector are all, substantially levered. So I don't really worry about that. There's a chance rates come down. It would kind of help the portfolio a little bit. But where we are right now, the other thing is when we reinvest the capital, it's at very high rates of return. Everything earns 3 to 5% more than it did in a world in which you had 0 rates. It's why we could build up things like the private credit allocation and generate a 10% plus return. We originally had no private credit allocation in the trust because we couldn't generate those types of returns. It was sort of, the market was giving you a 5 or 6. Now it gives you a 10 or 11, right? So, that's important. It's actually really important when you talk about things like IRRs, because let's say the market interest rates fell to zero. The portfolio would go up in value a lot. The NAV would go up in value a lot. The IRRs on the existing holdings would go up a lot, but we'd be reinvesting at very low rates of return. Right now, we're in this nice equilibrium where you're going to reinvest at rates of return that are reasonably high because of the higher rates, and the values are already priced in the higher for longer scenario, in terms of what's in the market. So I think you probably got right way risk when it comes to rates. That just there's a chance that they come down. Obviously there's a currency impact to that, which I won't kind of belabor. It's been a little bit bizarre that the US has higher rates than everyone else, and the currency's actually depreciated. That's more a function of policy and noise as opposed to kind of the rate dynamic.
Right, thank you. Corey, I'm going to ask you one last question. We are almost out of time, but just digging in a little bit further to that capital activity slide, fully recognizing that models are only models, but you are forecasting a capital surplus of $90-odd million over the next year. What does a miss look like, and where could we end up?
Listen, barring a major recession, which could delay exits a little bit further, you could find yourself kind of up 10-15% or down. We've actually kind of tried to remain very conservative as we look out over what projected exits are over the next period. They actually could look even better than what we're showing on that slide. But we have tools in our toolkit in the event that realizations are a little bit slower than we otherwise would have expected. We've utilized them to date as we've thought about how we made our new commitments. We obviously want to continue to remain fully invested, but we have a couple of larger commitments that will likely make next year as realizations come off, and we can just delay the timing of those off a little bit to make sure that we're still getting a very nice increase over our capital requirements in terms of distributions. And we will layer in those larger commitments over time and tactically deploy to opportunities that we see that are interesting over that period, all with a mind to just making sure that there's a nice surplus of those distributions over the capital calls for the foreseeable future. And candidly, now that we're at full investment, that is just naturally going to happen as things continue to come off. We're in a period where we're just making marginal increases in terms of our commitment activity, and it's being drawn down as distributions continue to flow from the rest of the portfolio.
There is a lot happening. The question here reminds me of a point that I failed to make when I was talking about the discount, which is at around 30% at the moment. In answer to that question, we are still continuing to pay the 4% distribution yield, which means that if you're buying at the moment, you're getting closer to 6%. So you are paid while you wait for the situation to resolve itself. We still do have questions, but we are out of time, so we will respond to those people directly. If you do have other questions that you'd like to ask, please get in touch with us. We really appreciate it when our clients engage with us. So thanks very much for joining us, and enjoy the rest of your day.